All right, let's get right into it. Today, we're diving deep into SLB's Q3 2025 earnings. And look, this isn't just another earnings report. What we're seeing here is a massive strategic pivot in action. SLB is literally re-engineering its entire business, moving away from the roller coaster of oil exploration and doubling down on two key areas: super resilient production and, you guessed it, high-margin digital. So here's the big question, right? You look at the energy market right now. Activity is kind of muted. The economics are tricky, to say the least. So how in the world did SLB not only navigate these headwinds, but actually engineer a path to outperform? Well, the answer, and this is the core of our story today, lies in two huge bets they're making. Okay, here's how we're going to break it all down for you. First, we'll hit the headline numbers. Then we're going to unpack those two big strategic pillars: that bet on production and recovery, and the absolute game changer that is their digital engine. After that, we'll see what management thinks is coming next, and finally, we'll give you our take, the next call, our official rating. All right, let's jump into the Q3 results. We're talking about the headline numbers here. Now, at first glance, it looks like a pretty solid quarter, but you know how it is with these massive global companies. The real story is always hiding just beneath the surface. So the top-line numbers, they look pretty good, right? Revenue hit $8.9 billion, and non-GAAP EPS came in at a solid 69 cents. And maybe most importantly, they generated over $1 billion in free cash flow. That's some serious cash generation. But, and this is a big but, that revenue number has some really important moving parts you need to understand. And boom, this chart right here really tells the story. On one hand, you've got this massive boost, nearly $600 million coming in from their new acquisition, ChampionX. But on the other hand, they got hit with about $200 million in headwinds from selling off a project and a pipeline issue. So you do the math. Take away that acquisition, and the core business was basically flat. Now that's not bad, it shows resilience, but it really underscores just how critical these big strategic moves are for them right now. And that leads us perfectly into their first huge strategic bet: building out this resilient core focused on production and recovery. Think about it this way. They're shifting their focus from the risky business of drilling brand new wells to the much steadier job of squeezing every last drop out of the wells that already exist. It's a way more stable, less cyclical game to be in. And you don't have to take my word for it. The CEO, Olivia Laguan, he laid it out perfectly on the earnings call. He said production and recovery is a new theme that needs reinvestment, that needs technology. What he's saying is, this isn't just boring old maintenance. This is a new frontier for tech and innovation. They're not just trying to manage decline. They're trying to actively reverse it using cutting-edge technology. So how are they doing this? Well, the ChampionX acquisition is the absolute supercharger for this strategy. What it does is it totally de-risks their business. It shifts their revenue away from volatile capital spending, the big one-off projects, and towards steady, predictable operational spending. It's the difference between a one-time construction contract and a recurring maintenance fee. And get this, the integration is actually running ahead of schedule, which is a fantastic sign. They are now, without a doubt, the biggest player in the game when it comes to helping their clients fight that constant, nagging battle against production decline. Okay, let's move on to the second piece of the puzzle, and honestly, this might be the most exciting part of the entire SLB story right now. We're talking about unlocking their digital engine. For the very first time, they've broken out digital as its own separate business segment. And what the numbers show? Well, it's like they've revealed this high-growth, super high-margin tech company that's been hiding inside an energy services giant all along. So what exactly is this digital business? Well, it's basically built on four key pillars. First, you've got platforms and applications. Think cloud computing and software subscriptions, pure SaaS stuff. Then there's digital operations, which is all about automation and running things remotely. Third is digital exploration. That's their super high-tech business of licensing out seismic data. And finally, you've got professional services, where they basically act as consultants to help other companies with their own digital journey. Okay, so how big is this thing really? Well, get a load of this. They ended the quarter with $926 million in annual recurring revenue. We call that ARR. For any software or subscription business, that's the holy grail metric. It's predictable, it's sticky, it's what investors love to see. And management is basically telegraphing that they're going to blow past the $1 billion mark very, very soon. That's an incredible foundation for growth. But here's the kicker. It's not just growing fast. It is wildly profitable. management is forecasting a full-year adjusted EBITDA margin of 35%. Let me repeat that, 35%. That is a massive number for any business, and it's what we call highly accretive. In simple terms, it's so profitable that it pulls the entire company's average profitability way up. This is that high-margin engine they've been talking about, and it is firing on all cylinders. So, okay, we've got the two big strategic moves in place. Now what does management see coming down the pike? Well, when you listen to them, it's really a tale of two completely different markets. What's happening internationally versus what's happening back home in North America. And the difference is like night and day. On the international front, they're super bullish. They're seeing strong, resilient growth driven by these huge long-term projects, especially in deep water and natural gas. They think this is where the next big upcycle is going to come from. Now look at North America. Yeah, a much different story. The word is muted. It's all about just trying to be more efficient, keeping existing production going, because the economics are just tough. And this right here is why SLB's global footprint is such a massive, massive advantage. And this confidence, especially on the international side, it shows up directly in their guidance for the next quarter, Q4. They're telling the market to expect high single-digit revenue growth, sequentially, and a really nice bump in their profit margins. Why? Well, two big reasons. They'll get the full benefit of a whole quarter with Champion X on the books. Plus, digital sales are always seasonally strong at the end of the year. The takeaway? The momentum is clearly building. Okay, let's pull it all together. We've gone through the numbers, we've broken down the two-part strategy, and we've heard what management is expecting. So that brings us to the big finale, the next call. What's our verdict on the stock based on everything we've just seen? All right, here it is. Our rating on SLB is moving to outperform. We believe the transformation we're seeing isn't just talk. It's real, it's being executed brilliantly, and frankly, it's setting them up to leave their competitors in the dust in this market cycle. So why are we so bullish? Our outperform thesis really comes down to three main points. Number one, that digital business is a secret weapon, and we don't think the market fully appreciates this high-margin growth engine just yet. Number two, the Champion X deal gives them a rock-solid, resilient foundation that protects them from the market's ups and downs. And third, they are perfectly positioned to ride the next wave, which is clearly going to be international. It's simple, really. Management has a great plan, and more importantly, they are actually pulling it off. Now, just for fun, here's a potential trade idea. And again, this is not advice. But a way to express this view could be what's called a pairs trade. You'd go long on SLB, betting on it to go up, and at the same time, you'd go short on a company that's focused purely on the North American land market. See what that does? It's a direct bet on that tale of two markets theme. You're capturing the upside from SLB's international strength while hedging yourself against that muted outlook in the US. And as always, guys, we have to say it, this is not financial advice. Please always do your own homework and your own research before making any kind of investment decision. Thanks for tuning in.